A very good evening to everyone. On behalf of the Institute, I, Sushmita Shankar from the Professional Development Directorate, welcome you all to today's webinar organized by the Professional Development Committee of the Institute under the able chairmanship of CMA Vijender Sharma sir, our Vice President of the Institute. And the theme of the webinar is Management Accountants Drive Creation of Organization Value. As we all know, management accountants play a significant role in forecasting future requirements and helps the management of the organization with the financial decision making. So the most important job of the management accountant is to conduct a relevant cost analysis to determine the existing expenses and give the suggestions for future activities. And to discuss on the same, we have the experts with us, our dignitaries and learned speakers among us who would be sharing their views and experiences with us, and they will get to know how cost and management accountants are important in creating value to the organization. So we are privileged to have with us CMA P. Raju Iyer sir, President of the Institute, and CMA Vijender Sharma sir, Vice President of the Institute. They are the guiding force behind all the professional development activities of the Institute. Thanks for your support and guidance, sir. Our eminent speakers, FCMA Paul Sharman sir from Canada. He is the Cost and Performance Management Specialist. Welcome, sir. CMA M K Anand sir, former Principal Advisor Cost, Ministry of Finance. CMA Sankalp Wadhwa sir, leading cost accountant practitioner, and all the participants. To start with our session, first I would request our Vice President CMA Vijender Sharma sir to address our members.
Good evening to all the members. Respected President Sir, CMA P. Raju sir. Respected Shri Mr. Paul, the today's speaker. Mr. M K Anand, my guru, and very vibrant person for the moderator session for the Sankalp Wadhwa ji. Very good evening to all of you. Today it's a very, very important program for all of us, because day and night we all cost accountant are discussing about this cost and management accounting, but we all discussing the scope for the CMAs or the cost management accounting in the Indian perspective. Today we are having Mr. Paul, who will be delivering his lecture to show us the way forward and the status of the management accounting in the global perspective. So the today program is going to be very, very important. So when Mr. Paul will be showing us the path for the global perspective of management accounting, we have Mr. Manoj Kumar Anand, who is having, who is an advisor cost from the Indian Cost Accounting Services. He was heading the cost audit division also, and he is having in-depth knowledge of the cost accounting. I think he will be very delighted to have you, sir. Then we are having the young and energetic person, Mr. Sankalp Wadhwa, who is basically the person who is updated with the all technical information, the technology, with the management accounting. So I think with the passage of time, the technology playing a very, very important role for converting this database into the information for the decision making. So I think the today's program and is very, very important for all of us. I wish that more time should be given to the speaker. So I wish to have a successful program with this. Thank you very much. I'm sorry, I am attending the program from the car, so I'm not appropriately visible. So thank you very much, sir. Please over to Madam Sushmita, please.
Thank you so much, sir, for your encouraging words. Now, I would like to request our President, CMA P. Raju Iyer, sir, to kindly address the members.
Thank you, madam. Thank you, madam. Wishing everyone happy, healthy, and prosperous days ahead. And we are in a very excellent situation. And respected Vice President CMA Vijender Sharma ji, respected our honorable chief guest today, CMA Paul Sharma ji, who is from Canada and who is going to mesmerize us with all the details in cost and management strategy and how cost and management accountants will be able to perform and lead the globe for a successful performance. And respected M K Anand, who is our guiding force and who is our technical support, and Sankalp Wadhwa ji, who is a young and dynamic leader, who is updated with all the knowledge and everything, and respected my dear friends. I'm very happy that we are organizing the cost and management program, and it's an excellent time that when the globe has recovered from COVID pandemic, and when this Ukraine-Russia war also created pandemic, how the cost and management account will be strategically play an important role in economic development of the industries and the nations. So as a global scenario, Mr. Paul Sharman will be detailing the discussion so that we'll be able to have excellent session ahead. As a cost and management accountant, we should be able to perform and guide the industries for how they will be able to have a sustainable growth. Today's sustainable growth is very important. Same way, integrated reporting is gaining a lot of strength other than the financial aspects. So what are the non-financial parameters in cost and management accounting, and has to be taken place, and with our global leadership, we will be able to provide the strategies for integrated reporting also. It's an excellent day because I want to listen from our eminent speakers so that we'll be having the real value addition. Wishing everyone happy and healthy days. Thank you very much. Good day, good day, good day. Over to Sushmita.
Thank you so much, sir, for your valuable insights and encouragement to the members. Now, to proceed with our technical session, first I would like to introduce CMA Sankalp Wadhwa, sir, and then would request from him for the theme introduction. A brief introduction of CMA Sankalp Wadhwa, sir. He is a fellow member of the Institute of Cost Accountants of India, associate member of the Chartered Accountants of India, commerce graduate and DISA qualified. He is a certified SAP co-consultant. He is an executive education program. He has done executive education program from IIM Ahmedabad in leadership and finance. He did his internship from PwC. Previously, he was working with the PepsiCo as a business solution manager and currently spearheading a company in SAP consulting. He is also a co-opted member of the IT Committee and Cost Auditing and Assurance Standards Board of the Central Council Committees of the Institute of Cost Accountants of India. So, welcome to the session, sir. I would request you to kindly introduce the theme of the webinar.
Thank you, Sushmita ji, Honorable President of the Institute, Honorable Vice President of the Institute, respected speaker, Mr. Paul Sharman, is a very reputed international speaker on the topic for the day. M K Anand ji, retired from the government of India, has a very in-depth knowledge about cost practices and in the government sector. So we are very privileged to have Paul with us, who knows, who has the depth as well as the width of experience in this topic. How management accountants can create value to organizations. So I will give two examples, two fellow management accountants. One who's working in the healthcare sector. So he's our client and we work with him. When we started working with them, they didn't had any systems in place for management accounting. They had their financial accounting systems in place. And gradually, year by year, what happened was initially they developed systems in Excel, their costing records, and as they graduated, they developed their systems in ERPs. Now they have a management accounting system in ERP. What they initially started was they determined specialty-wise costing, but today they are able to get profitability on basis of doctor, on the basis of infrastructure, on the basis of specialty, on the basis of patients. So this journey started 10 years back and they have been progressing day by day. Latest, when I talked with that person in the organization who was spearheading this, he informed me that annually they are able to save $1 million to the company. It is a listed company, listed entity in the healthcare sector because of these management accounting practices. The second example I would like to give is of one of my colleagues who I worked with. He is currently in an organization which is a shared services organization. So he works with a cross-functional team, and there are MBAs and there are financial accountants as well in his team. The main objective of theirs is to do pricing. So they try to give prices to the services sector, to the services basically in different regions of the globe. And they have to see the intricacies of which country or what price point has to be decided based on the organization they are working with, based on the past practices. All these factors have to be put in place. So he also, as a management accountant, is contributing quite a lot in the organization. So I was really excited for today's topic when, and of course, Mr. Paul Sharman, who has agreed to speak on this topic, because he'll bring a global perspective to this topic. And I feel that as if we see India, unfortunately, we are trying to progress in the management accounting sphere. Of course, we have come a long way, but if I compare to the developed economies, they have actually done quite well in developing their systems for the management accounting, from management accounting perspective. So let's see what we have today in place. I'll be a patient listener, and I hope that everybody in the panel as well as in the audience would enjoy today's topic. Over to you, Sushmita ji.
Thank you, sir. Thank you so much for your encouraging words, your valuable insights. And now I would request Paul Sharman, sir.
Good morning, or good evening, I should say. It's morning where I live.
So before I would request Paul Sharman, sir, I would just like to give a brief introduction. Mr. Paul Sharman is a Canadian-based cost and performance management specialist. As a consultant for over 30 years, he has facilitated change initiatives in organizations in North America and around the world. He is sought after as a thought leader in the field of enterprise performance management. Mr. Paul led the New Jersey-based Global Institute of Management Accountants as its president and CEO, and was named as one of the top 100 most influential people in the US accounting world in 2005, 2006, 7, and 7 by Accounting Today. He served as editor-in-chief of the Thomson Reuters publication Cost Management for 10 years. Hundreds of his articles have been published in the professional journals around the world. Mr. Paul is a fellow chartered management accountant. He has led management accounting and controllership positions in industry for more than 20 years. Specialists in business turnarounds, performance improvement and management, cost management, strategy development and implementation. He has experienced facilitator and project team leader. He has trained thousands of professionals around the world on how to improve organizations' performance. So we would like to hear from Mr. Paul Sharman, sir, about the management accountants, that how they create value to the organization. Over to Paul Sharman, sir.
Welcome, sir. Welcome.
Welcome to the session, sir.
Welcome.
Thank you very much. It's a great pleasure to be here. Again, only on screen this time. I was at the conference at the beginning of 2020, and it was such a wonderful experience to join you at that time, and it's a wonderful experience to have the opportunity to speak to you again. So thank you for having me. Thank you for joining us. I have a set of slides, which I wonder if we could project as well, please. And while we're setting that up, I'll just start talking about myself a little bit. Firstly, I'm a cost accountant. I started off in Britain in cost accounting. I did some engineering first, and realized that understanding what the business is all about is really vital in order to improve performance of the organization. You can't improve performance of a corporation by just having good ideas. And I can tell you that I've had a career in management accounting, cost accounting, leading to management accounting that has now lasted over 40 years. And I can tell you it's given me a wonderful career. You heard earlier about my background, and I think it's rather special. Could we have the next slide, please? Which is, well, there's a picture of me at the conference at the beginning of 2020. It's see me with that wonderful gift I was given. My message to all cost accountants and management accountants is one of encouragement, because the world is changing so much that we have to take a look at everything that's going on within our environment with digital technology. And I'll cover some of those things. I'll use a few of the slides I used in at the conference, and then we'll get into the primary discussion, which is about creating value for our corporations. Anyway, next slide, please. And it comes down to what are our businesses all about? There is no question that we provide services and goods to our customers, and if we didn't do that, there'd be no money. But the purpose of all that is to make money, and then you have to deal with how you make money when you don't have any. So you have to actually invest in the business, and this is where the discussion of how you create value becomes really important. What we didn't say briefly at the beginning here is not only am I a business person, a consultant, and a cost accountant, I'm also an elected official, and I serve on 2 levels of government as a politician in the part of Canada where I live. And the notion of creating value it applies to every type of enterprise you can imagine. And when people will say to you, well, you know, there is difference between government and business, and that is true, but every organization is for money. There is no organization that functions effectively and efficiently without having money at its root. And so it's always the combination of money and values and services and delivery. And the question is, how do you optimize those relationships? And the answer is, it comes down to you and me. You know, we are the accountants in the world inside the corporations. And if we don't do our job well, then the organization doesn't do as well. So what I want to talk a little bit about then is, assuming for a moment we are for-profit corporations, not for-profit corporations, then our interest is to create money. And what that requires us to think about is how much money in the future will be available to return to our owners, our shareholders, for them to feel that they're getting a good deal and that they want to stay invested in us. So how can we do that? And I want to talk a little bit about that. So our next slide. And I'm going to start off with a statement here, and that is that our purpose inside a corporation, which is for profit, is to increase shareholder value. And you heard one of the comments about my background in organizing corporations. I was once working with a company that employed about 15,000 people, and they weren't increasing shareholder value. And the result of that was I helped them remove 5,000 people, workers. And you might think that's a really bad thing, but for the other 10,000 workers, it was a good thing. And for the future of the corporation, it was a good thing. So the very notion of managing costs is very central to our ability to help our organizations succeed and to survive. And it's central to our existence. The point about cost accounting and management accounting is we are the folks inside the business who knows what's going on. We're the people who can help our managers make better and more informed decisions for the future. Because if you think about it, the decisions we made yesterday got us to where we are today. But the decisions we make today will take us into the future. And that will either be a good future or not, depending on how good those decisions are and how well informed they are. So what I'm suggesting to you is your role, my role as a cost accountant, as a management accountant, is actually to make sure the quality of the information we're providing to our managers and executives is of high quality and good, and properly informed ourselves. Next slide, please. And I've talked about making informed decisions, but keep in mind, it's not on the past. And you'll hear me talk a little bit later about the emphasis that we used to have when everything revolved around short term. In the past, we would take a look at the current and most recent earnings. We'd look at the most current and return on investment. And in a moment, we could see stock market prices change if we had a good month or a bad month, a good year, a bad year. But today, it doesn't work quite the same way, because the fact of the matter is things change so dramatically that organizations can be destroyed or can grow massively based on the value of their intellectual property, based on the quality of the choices they're making today, looking into the future in a world that's defined by digital technology. And we'll come on and talk more about that. So we've got to focus on future performance. My message in this slide is that, and I work with many different groups of people in the roles I have now as a consultant and also as an elected official, that we have to look into the future and ask ourselves, where are we going? How are we going to get there? What is our purpose? And what is the value we have to deliver to all of our owners? And if we don't look in the future, we look in the past, we're looking in the wrong direction. As somebody used to say, you can't drive a car by looking in the rearview mirror. You have to look out of the front window. Next slide, please. And this is a moment when everything is changing so rapidly. The world of manufacturing versus service industries has changed so much. So if we take a look at the valuation of corporations around the world, in 1988 it was 9.7 trillion US dollars, and in 2018 it was 68.7, and it's grown since then. We have some current difficulties. But if you look at the note underneath that, what it says is manufacturing was 17% of is today only 17% of all business activity. It used to be more like 60 or 70% of global of business activity. In India today, it's 23%. And when you take a look at a lot of our accounting principles from the past, that was based on manufacturing thought processes and manufacturing processes. And today, those are still important in 23% of the case of organizations. But as one of our earlier speakers said, you know, if you take a look at organizations like healthcare or software, you know, I used to work for a company called Northern Telecom or Nortel, and we made telephone switching equipment. It had very little to do with our manufacturing cost. It had everything to do with our intellectual capital and research and software that operated the telephone switching system around the world. And so our biggest issue was marketing. Our marketing spend was more valuable than anything we did. So we have to think differently about this. And if you think about someone like Google, their enormous value is driven more by research and development and marketing than it is by what they produce. In fact, they outsource what they produce in terms of any hardware equipment they have, but it's not a lot. And so we have to think firstly about what has changed and what does that mean to the role and responsibility we have as management accountants and cost accountants as we serve the organizations that we are responsible for helping them make better informed choices, right? So it's a rather different argument I'm going to offer you right now. Next slide, please. And then you deal with the notion of risk. We didn't even talk about business risk very much until about 15, 20 years ago. In those days, everything was fairly calm. And if you go way back, life didn't change very much. There was risk, but it was relatively minor. But you look at the world as we understand it today, we can see an organization that was doing really well, even as recently as last year, become bankrupt next year. And the company I mentioned earlier that I used to work for was Northern Telecom, and it was one of the biggest corporations in Canada, and it was destroyed in the course of a couple of years by bad management. Very, very sad story. Or one of the early cell phone producers, BlackBerry, was everything in the Canadian stock market. People were using Blackberries around the world, and now we're all using Samsung or Apple, of course. So the notion of risk and where we create value, fundamental to that is simply a good idea. Somebody comes up with a better idea on how to do something, and suddenly what we thought was the best is no longer even viable financially, which comes back to my earlier comment that we must always be focusing on the future. Everything we do needs to be analytical and considering what's coming around the corner. We talked a lot about things called best practices. And today I don't use that term. The best term is next practices. What do we see coming down the road towards us? Best practices, the enemy of best is better. And if we're not thinking about better, we're sleeping, because change happens constantly. Next slide, please. Okay. Thank you. That's great. So change happens at a very different pace, as we just said. But along with change comes risk. And we can see the effect of weather patterns. And of course, we're all very concerned about climate change and really hot temperatures right now in India, for example, and its implications possibly on agriculture, water supplies, but more importantly on the patterns of weather are very volatile. And volatility is an aspect of risk that's really important, as we know from current conditions in Europe. And we see change in valuation, and we've got a picture of the stock market there as the second picture, and think just about in 2008 when the credit markets melted because of banking practices in the United States, and how we lost something like 40% of stock values overnight. And in a world where intellectual capital, intangible assets drive 85% of balance sheet valuation in corporations around the world, that can go down in a split second. A little bit of bad news and stock value drops because it's no longer defined by tangible assets. It's no longer defined by bricks and mortar, machines and land in the same way. You take a look at Apple's balance sheet, and probably 90% of the balance sheet value of Apple, its stock value, is entirely intangible assets. Therefore, I personally find that investing nowadays can be quite difficult unless you're really paying attention to the numbers. I have a friend who's very wealthy. He follows 26 different company stocks, and he works 5 hours a day studying those stocks every day, because he knows that with the millions of dollars he's got invested or is likely to invest at any moment, that he cannot take any risk because he can be wiped out in a second. Hence the sign of Wall Street, the cost of gasoline can change all very dramatically. So risk is always upon us. Change is always upon us. We don't know how volatile things are going to be. We don't know how the pace of change is going to be. We don't know what the impact of it is, but we can be prepared for it. And that's my message about looking into the future. Because if we aren't paying attention, we can be destroyed. But if we are paying attention, we can do things that are amazing. Next slide, please. The flip side of what I've just said is that there is never a change that we can't do well with. You know, Warren Buffett always says, you know, when the tide goes out, you can see who's swimming naked. But that is also true for people who are invested on margin accounts, who are using borrowed money to invest. However, if they're well informed, you can invest in things that are going to make a lot of money when the market's down. Who's making all the money when the market's down? Warren Buffett, because he's carrying cash in volatile times. If you take a look at the investment corporations or the financial analysts, they're not looking at balance sheets in quite the same way that they did 30 years ago. They're not worried about ROI to the same degree as they are thinking about future cash flow opportunities. Where's the money coming from? If they're going to invest, how much are they going to invest and how much cash, free cash will become available out of that? And it all starts with that little light bulb which says, here's a good idea. But a good idea isn't something you just make up. You know, I have children and grandchildren, and I can say with absolute certainty, I will not let them make my decisions for me because they don't have the depth of experience and they haven't fallen off enough cliffs to discover how badly things can go when all you're doing is making things up. The thing about the management accountant, the cost accountant, is that we have so much insight into our organizations that if we apply ourselves to thinking about what is coming and doing the analysis and forecasting of all of those costs, what we can do is we can use our knowledge of the past as a benchmark, as a comparator, and the basis for which to peer out into the future by asking ourselves, what happens if we do this? What happens if we do that? How much do we have to invest to take advantage of that? What do we have to start doing? What do we have to stop doing? All of these things become very central to our ability when we see change coming to turn it to an advantage. This is not about doing things to make just things a little tighter. This is about making giant changes and being ready to go. Next slide, please. And hence my point about good information. Volatility is not something we really talked about very much a few years ago because things were relatively stable. Markets largely influenced by tangible assets. But when you start talking about intangible assets, as I've said already, things can go very differently than you ever expected, which says that you actually need to be preparing all that information up front. You need to be doing it now on a continuous basis. And that's really important so that when the management say something's happening, what do we have to do to avoid this problem? You already have the data. But that means you and I have to change. Next slide, please. So what's this got to do with cost accounting and with management accounting? There was a very famous author, a researcher, who in 1996 wrote a book about shareholder value, how to maximize shareholder value, and his comment was, it all depends on having the right information and helping the behaviors of the people who are responsible for looking after the business of our businesses, and making sure that we're returning a good value to our shareholders for the long run, not the short run, right? So one of the things that most people don't recognize is that tomorrow isn't very far away, that really people are looking to invest in businesses that are going to produce cash flow and cash flow returns to them over the next decade, the next 20 years, 30 years. You know, one of the things that I've managed to accomplish that I'm quite proud of, and this is not mostly about me, but it's a little bit about me, and that is that in the city of that I am, in which I am an elected official, We are the only municipality in North America who has got a 25-year planning horizon on its strategic plan. And the reason it's 25 years versus 3 years versus 5 years, you know, people have all sorts of weird ideas, is because we have $5 billion with assets invested on roads and buildings that we have to finance the maintenance of, and their lifespan has to be at least 25 years. So we have to finance it for 25 years. So the same goes to other businesses. So for example, if you're in the cell phone business, the strategic planning horizon is not 25 years. It's probably more like 6 months or a year. So depending on the business you're in, you have to be very careful about thinking around the resource logic. You know, one of the things I'll talk about a little bit is strategy formulation. Central to strategy formulation is the strategic planning horizon. Central to your ability to help investors invest in your business relative to that strategy is resource allocation. So the purpose of strategy formulation is resource allocation. And that means you've got to understand the business really well and the dynamics of it. So our purpose, which I agree with from Alfred Rappaport, is we need to make strategic decisions that maximize expected value, even at the expense of lowering near-term earnings. We should not be worried about the short-term matters. We must think about how we're going to get back on track, how we're going to stay on track for the long term, so that people can continue to get positive, good cash flow from us for decades to come. Next slide, please. This is again from Rappaport, and it's a little tough to see, and I'm hoping that that my colleagues here at the association can share my slides with you later, so that you can see this. But the fundamental to Rappaport's logic is 10 principles. Don't manage earnings. Don't manage earnings guidance. He doesn't think you should do that, because what that does is it causes the market and the analyst to be thinking about the short term. What you try to do is think about the long term. So don't worry about near-term earnings. Try to focus on maximize earnings and cash flow for the long term. So the reason I put this slide up here is you'll notice some of them are I've highlighted in green, because these are things that you as management accountants, cost accountants, absolutely have control over and influence over. For example, measuring incremental value of future cash flows. You could do the mathematics to support that. What are the strategies to create value? You can be providing and must be providing the information to executives and management to determine that. What is the mix of investments? And I'll come back to that question in another later slide, because that rear view mirror view of the past, oh, we've invested $100 million. How did we do this year? No, bad, wrong answer, wrong question. How are we going to do in the next 10, 20, 30 years? Where's that? Where's the cash flow on that? What strategies do we have to have? What risks do we have to be aware of? What actions do we have to take to mitigate risks? And then item 3, make value acquisitions that maximize expected value. So the management accountant, the cost accountants are going to be thinking in terms of, yes, that's the cost, that's our background, but how do we take that information and leverage it for creating future value? Carry assets that maximize value. Item 4. So reducing our capital invested in value-adding activities. Let's just try to become more effective. So we've seen a lot of electronics and corporations around the world that produce goods is they outsource the manufacturing of their products, and they put their energy into focusing on intellectual capital, because that's where they get the most leverage on the value and the balance sheet. And there are a couple more items on here, but please take a look at them and think, as a management accountant, as a cost accountant, how can we better help our managers to understand the factors that Rappaport was talking about that will help our corporations and our organizations create more value for shareholders, that means for the clients as well, the customers who get good services. It's for everybody, the employees. It's the way forward that is positive for everybody. Next slide, please. And the critical issue here is simply, it means that somebody has to have their eye on the ball. I suggest that the cost accountant is the analytical person who knows where all the information is. And what we have to do is shift it towards looking into the future. So if there's increased competition, so what? What are we going to do to offset that? So one of the things I've been working with recently is artificial intelligence to assess market performance on specific products and brands in corporations around the world. And with that information, what you can do is you can use AI to find your strengths and weaknesses, to find the markets that will help you to focus on which products and which services to sell in which markets. And if you can do that, then you can assess what the sales revenue might be. And you can do what if analysis. You can understand cost analysis, how we're going to improve the cost in that context. So all of those things become really important, even down to things like understanding the weaknesses in the financial markets and how that might influence your ability to survive as a corporation. But it's all within your scope. Because again, management accountants, cost accountants, I believe we have more insight than any other accounting entity, any other accounting competence or certification than any other in the world, because we know our businesses. You know, I always feel that the management accountant is the scorekeeper, is the numbers producer, is the information producer, and all the other accountants are all looking over our shoulders and then reporting on whether a good job's being done or not. And I think that's not particularly helpful. We are the value creators. Next slide, please. And next, push the button, please. And again. So the history of accounting goes back to a monk in Europe, probably in the 16th century. And then along, and that came brought the double entry bookkeeping system. And then along came the Industrial Revolution in late 1800. And it's only as we move forward from that, we've gone from planning for the next year, because we made the assumption, a reasonable assumption, that things would proceed in much the same way. Back in 1890, back in 1920, you know, the world was evolving around bricks and mortar and manufacturing processes. And people were looking for incremental improvements. Well, how much better can we do next year? Nobody was thinking that they could create a $50 billion business, or what is it? What is Tesla worth now? 200 billion or trillion? I don't know. But that happened all in a very short period of time, as did Google and Apple. So incremental no longer is in our minds. It's now taking advantage of the opportunities globally. Tangible assets, inventories, machines, building were the key drivers of shareholder value. That is no longer true. Tangible assets are stuff, but the big value is elsewhere. Product and strategy cycles were long, but today, if you look at a cell phone, it's very short. If you look at a computer, if you don't change your computer every couple of years, you're out of date. At the time, we would say, well, cost and price have a very strong relationship. If cost goes up, we'll pass along as a price increase. But nowadays, you can't do that, because at the same time that there's a price change or a cost change, it may be because there's something you're missing and you need to be more adept at changing and to new technology. And it goes on. Suppliers were in charge of markets. People were gaming numbers, all gone. So today we have to respond to change rapidly. We have to be prepared to talk about next in class, as I mentioned earlier. We have to think about intangible assets. fascinating thing is 30 years ago, balance sheet were 85% value based on tangible assets. Now intangible assets make up 85% of balance sheets. The most important person in your world are customers, because they can move on a heartbeat. And we can't game the numbers anymore because we're the only people we're kidding are ourselves. Right? When you game the numbers, try to get a short-term advantage, but in the next time something goes wrong, you're not prepared for what's really happening. So we had to change our thinking. But management accountants, it's all about data. It's all about analytics. It's all about stuff you know and you can do something with. Next slide, please. Here we're talking about then what I would say is the new mantra. In the past, we've tended to focus on short term. We've talked about budgets. We've talked about standard costs and variances, and those are not going to go away. But we now have to start thinking well beyond that. What we have in the past, all the bookkeeping, all of the audits, the stock markets, you know, they do a job that's important because what they attest to is the credibility of the managers and the who operate the businesses. And we have to know that they are doing a good job, that we can have confidence in what they say. We also need to know from an accountant's point of view, a management accountant's point of view, that we have a set of numbers in our records that represent the truth, and they are the basis for us evolving into the future. But that is called hindsight. And hindsight is like looking at yesterday's pictures of your children and grandchildren. It's all pictures of yourself from last year. That is hindsight. Present insight is today's picture, and what you see is different about it. And it could be any aspect of your life, but it's only fleeting. It's worth the moment. Where the real information becomes important is future insight. Where are we going? How's it going to happen? And how are we going to help it get to where we want it to go? And that, to me, is where management accountants become really central to the future of the notion of creating value in corporations. So we have hindsight, we have insight, and we have foresight. And where we management accountants have to do from a global point of view, like it or not, is we have to be focused on the future. And we should be doing all the numbers that require sales and marketing insight. It requires artificial intelligence. It requires us to be using digital tools to do analysis and simulation modeling. And we have to be thinking robustly about strategy formulation. Next slide, please. So I've talked about shifting your focus to the future and the financial implications of that. I'm a management accountant. I worked as a cost accountant. I knew nothing about strategy formulation. And today I can't function without knowing strategy. Today I can't work with the organizations I do unless I've caused them to do a robust and well-informed strategy formulation process. And I use that as being different from the term strategic plan. The strategic plan is the articulation of the thought process you've gone through to think about where you're going in the future. I urge you, my colleagues, to start thinking about strategy and taking it seriously, because underneath all that is your understanding of risk and volatility and financial opportunity, and how your organization needs to respond to changing circumstances. That gets us into financial planning and analysis. That's where we do the strategic plan. And every strategic plan needs to have numbers underneath it. What are the financial plans to support the strategy? And it doesn't matter whether it's 1 year, 3 years, 5 years, 25 years. You have to understand the resources required. And that's where management accountants start to migrate into the notion of financial planning and analysis. We need to cover the waterfront. I don't plan to talk about those two items that much, but I do plan to talk about driving shareholder value analysis. And there are three things I'm going to talk about. One of them is economic profit. The second is going to be free cash flow. And the third will be discounted future cash flow. And my last thought to you is going to be how to embrace value-based management in our profession, I recall back in 2020, we were going to increase the gross domestic product of India by a very significant number. What was it? 3 times bigger? I don't recall now. It was so big. You had to step back and think this is massive. But fundamentally, it's the management accountant logic that will facilitate that change or any change to happen. And better that it be managed than it just be hoped for. You have the power to do that. Next slide, please. So thinking about value-based management, then our purpose is to drive value for key stakeholders. And I've used the word stakeholders here because I want to include customers and employers and everybody in our value chain. There has to be a win-win for everybody, because without customers, you have nothing, right? So they're the people who give us the money. You know, we used to have this thing in the United States called the Malcolm Baldrige Award, and they focus relentlessly on better quality processes, better quality products, but they kind of ignored the customers to the point, or rather, that's actually not quite true. They put so much emphasis on pleasing the customer that they forgot all the other aspects of their business in terms of making sure that their processes worked and their employees were being happy. And so eventually a lot of them went bankrupt. They got the Malcolm Baldrige Award. They had great quality, but they went bankrupt. So they weren't thinking about it holistically. My point is you have to think about it holistically. Focus your business on what counts. But my word here is relentlessly. Management accountants are the source of information in our corporations. We have to focus on the numbers in every aspect, as I showed you in the slide 2 slides ago that talked about hindsight, insight, and foresight. If you're only looking at hindsight, it's not enough. We've got to think about the future. And that relates to the deployment of strategy and a set of management philosophies. And on top of that, we have to establish accountability at all levels to achieving good value. Value-based management is not a buzzword. It's about managers doing the right things to improve the performance of the business. Next slide, please. I'll go through the notion of economic profit very quickly. So this slide simply says our traditional financial measures simply say we've got capital employed to help us generate return on to the investors. Then we have traditional financial statements and measures where we can tell how much profit we made on operations. We pay interest on the borrowed capital, and that gives us profit and taxes as well. And that just gives us profit after taxes. We don't actually determine whether that's a good return to our investors or not. It's an accounting thing. It doesn't really relate to the business we're in and how we serve our stakeholders. Next slide, please. What we do is we take our revenues, we calculate our cost of sales, and we do put a lot of effort in trying to make those things correct. But typically, they're not that big a proportion of the total cost. We have many other costs like selling and admin and marketing and then interest and taxes. And then we come up with a number called profit after taxes, and it's all accounting based. Next slide, please. If we take a look at economic profit, it looks at the degree to which we produce value greater than the cost of capital. So if we think about, if the investor could take all their money and invest it in another enterprise or in a bank, leave it in the bank, then they would get a certain rate of return. So let's say they've got $100 million in, they could invest it in the bank and they get $5 million a year. So let's say they get 5%. So if you can't do better than 5%, you're not making any money for them. Economic profit is where we take the operating profit minus the cost of capital, the weighted average cost of capital, and what you get left over is the real value returned to the investor. And that's a critical difference from our emphasis as accountants on serving the accounting requirements. in order for us to think about how we create value for our stakeholders and our investors, we have to do better than the banking system, or better than alternative sources of capital or investment. The difference is how much more we give than they might get otherwise. Okay, next slide, please. And so what you see here is a P&L that shows revenues minus cost, and then our operating margin, etc. And then we get net operating profit after taxes. We can take away any other activities we've been paying for, executives, overheads. And after that, we get some sort of view of of our profit after taxes. If we then deduct 9.2, which is the capital charge, the weighted average cost of capital that we incur, or then what is left is $9 million of economic profit. In other words, that is the additional profit we give to our investors. Had they put their money somewhere else, so they wouldn't have got that. So by giving us, it's by investing in us, we're giving them significantly better return than they would otherwise get. Okay, next slide, please. So let's talk about shareholder value, because it's slightly different. So the very first notion was economic profit. The second, so that gives us some indication about shift from an accounting view to understand how the shareholder gets money back at a better rate than they can get anywhere else. Shareholder value recognizes that shareholder value is the market value of common shares. In other words, if you take a look at the stock listings, the value relates to the notion of shareholder value. So there's the price that you pay, and there is actually the calculation of shareholder value by the company. So the management accountants who work inside the corporations, they are the ones who understand shareholder value by understanding the numbers, and we can calculate what it's likely to be by doing the projections. Critical to this, as today's valuation, is not how we did last week or last year. It's got to do with future expectations, and hence the notion of discounted future cash flow. All right, so I'm going to invest $100 million with you today, and I expect $5 million each year, not just next year, because I'm in here to get my money back and for the long term. So I want to know how much you're going to be making for me in every year relative to the expected returns on that investment. So if it's a 20-year investment, then I want to know in the future, how much is that going to be worth to me? And how does that compare to if I put my money somewhere else? So you'll know that poorly performing companies reflect the breakup value of their company. In other words, when you look at the stock value, it's related to the calculation of the discounted future cash flow. And if it's actually not going to produce numbers better than investing somewhere else, it's the breakup value of that company. Shareholder value is created by generating returns in excess of the cost of capital. This is where economic profit becomes important, because it is the excess in terms of the expectation of a decent, normal cost of capital employed. And I always say, but don't forget, when we use the word maximize, and you saw on my slides earlier, the word maximize, the shareholder also wants the customers to keep giving money. So maximize means with very high degree of customer satisfaction. It also means our employees have to be motivated. So it's all part of the same thing. Next slide, please. Next slide, please. No. I think there was one before that. There's one before that. There you go. So let's give you an example of this. Sankalp gave the example of a health company. This is an example of an airline company. So the notion of value drivers. So I spent many years helping organizations understand activity-based costing, and we would use the term activity drivers and cost drivers. So here we're talking about value drivers. So now a lot of simulation modeling in my world revolves around building simulation models, mathematical models based on your existing P&L balance sheets. And what it deals with says, okay, then how can we make a much larger improvement in our discounted future cash flow? And in the airline example, so 4 basic things: revenue, customer satisfaction, operational effectiveness, capital efficiency, and innovation. So in the revenue increasing and customer satisfaction, if you can increase prices with no volume impact, that improves the value of the company because you're going to get future cash flow. Switch mix to higher fare passengers. You can do that. All right. So these are pretty obvious. Operational efficiency. You can reduce lost baggage claims by taking better care of passengers' luggage, taking advantage of fuel price gains. Here's another one that's pretty exciting. You know, probably 25 years ago, every airline was flying big airplanes. Today, they have big airplanes and medium-sized airplanes and small airplanes, and they match the capacity of the equipment they're flying to the demand for each route and each time of day. It's all managed dynamically. And what that does is that reduces their operating cost, therefore becomes more effective. But at the same time, into capital efficiency, it reduces the wasted space and seats in aircraft that are flying every day because they were too big, right? In any event. So there are some other things associated with capital efficiency, reducing the settlement payment. You know, I had one client. I've been working with them for about 5 or 6 years now, and when I started helping them, they were technically bankrupt, but they had revenue. They had lots of revenue. So the way we managed to bring it back into out of bankruptcy was we just delayed payments to our suppliers with their agreement, and what that did was help us become financially viable and liquid for the next 3 or 4 years while we made that transition. And today we have a very profitable and very viable corporation. So just by managing money, and then of course innovation, and think about how it's gone from travel agents to now digital, making bookings online on your computer, reducing costs, more effective and efficient, quicker, better. And that allows you to manage fare services a whole lot better. All I'm saying is value drivers are real. They're not just good ideas. They are things that you can do within your business. And then if you're not looking for them, then you're missing opportunity. Next slide, please. The notion here of long-term firm performance comes out of INSEAD and Wharton. And these were the top value producers based on economic profit from 1999 to 2018. And what this shows is if you take a look at the consolidated, discounted economic profit gains by company, the biggest gain was Apple, and it's $1,000 billion. Amazon, great. And it moves on. Right the way down to Nestle. And then you get companies like General Electric that lost money for their investors. MCI WorldCom, a client of mine, went bankrupt because they was not managing their financials very well. I remember visiting their executive VP for operations, and we were just about to complete redesign of their costing system. Using activity-based costing. And he said to me at the time, well, we've had all the big names. We've had Arthur Andersen and KPMG and all those people in here. And what they've done is they've always told us to do the same thing. Take the total cost of the network and divide it by the number of bits. And that gives us an average cost that we've done with very well. What we did was we said, well, how can that help when you've got clients all over the world where you've got different infrastructure requirements and you have to transport data from one place to the other, where you have your operating systems in one country, and then let's take a look at the cost of maintaining all that infrastructure. When we came back, finished the project, they completely redesigned their pricing algorithms because they had it wrong. The old system of allocation, standard cost, was not effective for them. My point is, management accountants, cost accountants, the way we do our job in a dynamic world where the nature of value based on discounted future cash flow is fundamental to our ability to survive. We have to look at what we're doing and ask ourselves, what do we have to do different given the circumstances we operate in today? Next slide, please. Now let's talk a little bit about free cash flow. I think I'm probably running out of time. I'll be finished fairly soon. So the very notion of free cash flow then is a little different in the sense that it also takes a look at the amount of cash you have available even after you've invested in working capital and capital expenditures. So you've got to you add some non-cash expenses in, and then you deduct increase in working capital expenditures. And what that is, the amount of cash that you actually have available to use for other purposes in the future. Next slide, please. So that is the basis of our discounted cash flow. So we want to take a look at the estimating the present volume of an asset or project or new service based on the stream of future cash flows that you expect. People get really anxious about this when I talk about it. They go, well, you're going to be making assumptions. Well, yeah, but don't you make an assumption every time you cross the road? Don't you make an assumption every time you wake up in the morning when you take on a new job? Why are you not worried about making assumptions about that day, that issue, but you are worried about making assumptions about the future? Let's face it, the whole point about business is to make money and do better than other people, where the investors can go. And that requires us, who are the most informed financial people in our organizations, to be thinking about the future and making assumptions. But we can test them and we can provide alternatives by doing what-if analysis, scenario analysis. Simulation modeling is central to this conversation. It's not absolute, it's not accurate, and we have to understand risk, okay? So this model relies on the concept of time value of money. In other words, we're going to look out into the number of years, not necessarily 3 years, but it might be 3 years. It may be 25 years, but it depends on the strategic planning horizon of the corporation. That is a term you need to put into your brains and keep it there. What is our strategic planning horizon? It's difficult, but that doesn't make it wrong. If you don't do it, that's wrong. You're guessing. You're hoping like heck that whatever you're thinking will be right. So while we say it's difficult to accurately predict, the question is, how wrong can we be? To not think about it is wrong. Next slide, please. So I've already said it's about predicting future value. It's time value of money. And I've talked about requiring management accounting talent to predict the current inputs for the model. So that's in summary. Next slide, please. Now there is an example, and I actually happen to like this one as against EVA, economic value added, which was from about 25 years ago. My personal experience with this was I was involved with planning, strategic planning, financial analysis when I used to work for Nortel, and they were completely sold on using Rappaport models. And the model that we always did was for every major investment stream, every major product line, new product that we were introducing, we would do an analysis of the future financials, looking at the planning horizon. How long was that product line going to be available? And then we'd take a look at the discounted future cash flow. And then what we would do, it was look at them all together. So each one had to meet certain thresholds. And then what we had to do is put them all together, calculate the total company set of financials in terms of CVA, cash value added, in order to determine the value of the corporation going into the future. We became one of the most valuable corporations in Canada before it got blown up by bad management. Next slide, please. This slide simply shows how H&M and Walmart looked at different investment streams by year over 16 years. So they would calculate the CVA for each one of these projects. So S1, strategic investment 1, strategic investment 2, 3, 4, 5. They were each investment streams by year. And what they were looking at was the free cash flow in each year. And then they could aggregate that through time so that they could see what their future cash flows would be on a discounted basis going out over 16 years. If you do it in a short term, you get to see negatives because you continue to invest. So this is just a quick example of what I'm trying to suggest to you. Looking in the rear view mirror, looking at ROI, not helpful because it doesn't give you kind of this data. This is a very helpful perspective. This is a mind changer for me. Next slide, please. I appreciate that what we've been talking about is difficult and somewhat familiar. It's things we hear about, but inside of corporations, people may not be thinking about it. They may not be talking about it. It may be too difficult to talk about because we don't do it routinely. I find we get resistance from the financial accountants who say, no, by law, we have got to produce these financial statements. And oh my gosh, we got to be audited. And those are the biggest things. And I'm thinking, no, they're not. They're necessary, but insufficient. I wouldn't even support those. You know, I sit in audit committees and really, as long as I see that people are doing their job, I don't care because I want to look into the future. Here's the logic I'm going to offer you. It has to be simple. This is not complicated. It just requires us to think differently. We've got to start applying our time to think about these subjects, but we also need our executives and our managers across our corporations to be thinking about their accountability, to be thinking about future cash flows, how to be more efficient and effective. People have to have a clear line of sight. What I mean by that is you have to know as a manager, if I do this, it has this impact on cash flow and shareholder value. We can teach people how to do that. We've got courses on how to do that. And then we have to get into all those other things we routinely do, like cycle time, customer satisfaction, and balanced scorecard, a really helpful device. We, as management accountants, can be the economic profit coaches to provide our corporations with the ability to sustain success going out into the future. Get the buy-in from everybody in the corporation. This is not a trivial undertaking. I'm not suggesting that it is. But let's face it, if you get it right, you could become Google or Amazon or Apple. It's all about making progress and getting people thinking about the future. Next slide, please. So I'm going to offer you a challenge, and I made the same challenge back in 2020 at the conference. I'm a management accountant. I worked in cost accounting. I now think about creating value. You can too. And the way you do that is by learning new skills, understanding what this all means, getting the data, doing the analytics, thinking about planning. What about the digital tools available to you? There are plenty of tools out there that can help you do analytics, using artificial intelligence to assess the markets that you serve. But mostly, you earn your money when your executives make better choices as a result of the information that you provided. More successful choices that drive dollars because of what you've done as professionals in your corporations. Next slide, please. So that puts you in charge. You are the orchestra leader. I've always thought myself as somebody who had influence in the corporations that I served. And I am totally confident about that. Sometimes people say to me, you're a little bit of an egotist They're overconfident. And I go, no, I just believe that we have tools that we can use to make a better future for our organizations and the people we serve and the people work in them. And you can do that too. Next slide. Thank you. And by the way, my colleague Vijender here in Canada, who's a friend of mine and has served CMA India and in the United States, it comes and visits you every now and again, and he's always asking me to help the ICIA, and I'm pleased to do that. Anyway, I'll be pleased to take any questions. Thank you.
Sushmita ji?
Paul, this was a really mind-blowing lecture what you have given, and I am sure all the developing countries and especially countries like India really need such type of an approach and a change in the thinking pattern of the management accountants. I'm extremely grateful to you. You see, as Sankalp was mentioning, this is a separate link, and the seminar is being it has been released on the YouTube. So maybe we may not have any questions right now, but
we have some questions.
Sorry, we got some questions. Okay, yeah. All right. Sorry.
Okay. So first of all, I would like to inform that around 250 people participated in this, and 100 are currently viewing it. So it has reached a very wide audience. Now, one of the questions that our members have asked is that if you coined the term that there should be long-term strategic planning, and for one of the constituencies where you are working, you have made a plan of 25 years. So one of our members is asking that though there should be long-term strategies, but unfortunately, if we see the present day valuations of startups, they are skyrocketing. So do you feel that is it justified how the things are happening?
Thank you very much. It's a great question. It becomes a question of maturity and who's behind those startups. The venture capital model assumes 90% failure. So what they do is they invest in corporations, smaller, what is big to the owners, but on the assumption that 1 in 10 of their investments will pay off big time, and that will serve their financing objectives. Whereas what we've been discussing is not associated with that model. It's associated with sustainability of existing corporations.
Yes, I totally agree with you. So then there is another question from one of our members. So I think he's a fresher management accountant, and he's asking that what do you think are the skill sets for the budding cost professionals to possess in this challenging business scenario?
When I left school, I wanted to be like Mick Jagger. And I discovered that I couldn't sing. So you've got to have a passion for numbers. Yeah. You've got to think strategically. And what I mean by that is being willing to look beyond what's in front of you. Right? It's, when they say if you're driving your car and you see a car accident happening in front of you, a lot of people will watch it and they'll drive into it. But the strategic thinking person is looking all around them to see which other ways they can go. You have to be that person who has freedom to think and is willing to explore. I'm on my 5th career and I'm an adventurer and I want to get out there and do things, right? So I think it's actually, if you understand, you don't even have to be a mathematician. You have to be able to understand numbers, and you have to be able to figure out what's going on. You have to love people, And you have to be able to think differently, out of the box.
So one of the questions which I wanted to ask you, and since this was planned, and I think this is a great opportunity for me asking you, that so you can see that technology is playing a very key role in today's business environments. And I have been personally involved in SAP consulting in the past, and currently as well, I do. How do you feel that management accountants can leverage technology in the current scenario? And how do they use it? Because if I see, I was reading in some of the articles that accounting jobs, which are very basic in nature, might get redundant in a few years' time due to the advent of artificial intelligence and other new technologies. So, as a management accountant, how can I embrace these technologies? This is my question.
Well, thank you for that one, Sankalp. The creation of S/4HANA opened the door for management accountants and closes the door for auditors. I think it can't be more simple said than that. There you go, because if we can automate looking through the rear view mirror, reduce the costs, have much better reliability in our accounting records because they've automated the reconciliation of balance sheet accounts and things like that, where where they're using test routines and artificial intelligence to do sample tests. I sit on audit committees. I know all about this, and we have SAP in our organizations. But the value is in the future. So the beauty of S/4HANA is we can use the existing database to extract and forecast. And they've got the tools to do that. So I'm pretty excited about that, because what it allows us to do is then do bolt-on simulation models that do the extracts directly out of SAP, put them into our simulation models, and then we can start making assumptions and doing what-if analysis. So for example, in the United States here, there's a well-known sporting goods manufacturer, global company. They can now do a forecast update for a change in circumstances and get it to management in 1 hour. It used to take me a week to do that. The technology is stunningly supportive of what I've been talking about. Does that help?
Yes, sure. I think over to M K Anand, sir.
Thank you, Sankalp. Our President, Mr. Iyer, Vice President, Mr. Vijender Sharma ji, my dear colleague Sankalp, Sushmita, and our chief guest for the day, Mr. Paul Sharman. Yours was an excellent insight into how we need to change our focus into future. So I remember a good book by The Art of Long View, which was written by a European a long time back, where he predicted the fall of oil prices, shell oil prices, basically. You see, to be very fair to you, I think this today's seminar or today's discussion should have been physical rather than online, where we could have bombed you with hundreds of questions, because all our members are really bubbling to talk to you, and it should have been at least 4 to 5 hours, basically. So maybe I request our president to really consider requesting you to fly over here in the coming winters. And at the same time, I would like to place on record my deepest appreciation for my friend, Devendra Singh Bhatia, without whose persuading you or without whose very persistent efforts, today's seminar was not possible. Paul, I'd like to take 2 or 3 minutes of your lecture, basically. I find it very stimulating. And particularly, in particular, your idea that we can drive a car looking into the rear view and we have to really look forward. So I think your focus is that as management accountants, we have to now look little far, and we have to be aware of the changing signs, which perhaps BlackBerry or some other you see VCR manufacturers or maybe camera manufacturers fail to see. But Paul, I like to draw your kind attention to a fact that a company, solid company like General Electric, you see, which was founded by no other than Thomas Edison, who really invented the bulb. And then comes Jack Welch, and he systematically, you see, I'm sure the systems would have warned, the early warning systems would have been there, but perhaps, so maybe the management accountant, by looking into the future, looking into the technology, also have to be taking into account the systemic changes of the management per se. I mean, if the management is being headed by certain people, so perhaps management accountant have to really comment on that. See, why? I mean, you're redefining change. I mean, to me, it always comes as the change is painful, but you defined it as change into increased risk and increased opportunities. This is a wonderful metaphor you have tried to bring over here: increased risk and increased opportunities, and informed decisions to increase value ultimately for the shareholders is the ultimate motto of our management accountants. You see, in India, we are trying to build up a large economy. Basically, our Prime Minister has given this call to the business leaders over here. And as you are aware that India is a very big mix of public sector undertakings and private undertakings. So I think your advices are most relevant to both of them. And public sectors are also required to look into the future. And I mean, very interesting things we are watching in our Indian stock markets. I'm sure you guys also must be looking into that. You see, for last at least a month, all the foreign investor or all the foreign institutions are selling and all the domestic are buying. So I don't know who is going to be trapped or killed into this this thing. All the FIIs are selling and all the DIIs are buying basically. But that also takes us to one very solid strength of Indian economy or the Indian people. You see, our saving rates are very high. So maybe the savings going into the mutual funds are making the domestic buyers more strong to make the stock market more stable, or at least not averse to all the Ukraine or all such type of Fed rates or all these type of things basically. In the end, Paul, your examples of airlines and your examples of SAP and the integration of technology making us very quick decision makers or taking us to the nearness of the basic data itself is really very interesting. You see, like airlines, you also must be witnessing the food and the deliveries done by all the common Amazon or all these people are now taking the world over. And I think very small component of savings in by the management accountants by simply replacing the packed boxes with some bags. You see, this is what is happening in India now. They are replacing the packed boxes by certain bags where they show the articles to the customer physically, and then they take the bag back basically. So maybe some such small savings, or the management accountants are really, I mean, somebody must have gone into in a very detailed analysis and scrutiny of that. I'm sure, Paul, all our members have really enjoyed your very lucid talks, and you made it so simple and you made it so synchronized and you made it so seamless that all of us were wanting that you keep on talking, but I'm sure the everything has a limit, and I look forward to your being here in India sooner than later, and I urge upon our president to really look into this. I once again thank you for taking out your time to address us despite your extremely busy schedules, and we are really very grateful, Paul. And I'm sure if there are certain questions, our people, Sankalp or Tarun, they can really forward it to you for your interactions. And I wish you great success in your endeavors, whatever you are doing, and wish you great health. Thank you very much, Paul.
Thank you very much, Manoj. I really appreciate your kind words. And, it was a delight to have the opportunity to speak. And of course, I'm always at your service.
Yeah. Thank you very much.
Thank you so much, sir. Thank you, M K Anand, sir, and Mr. Paul Sharman, sir. Thank you for your encouraging words and for your knowledge sharing. Thank you, Paul, sir, for your thought-provoking speech. Thanks a lot.
So Paul, we have a tradition in India to give a small memento at the end, but online, you see, so this is a small memento, and I'll urge upon my friend D.S. Bhatia. I'll speak to him, and we will surely get it delivered to you sooner. Basically, thank you very much. Basically.
Thank you. Next time when we are meeting, we'll be definitely arranging the memento.
Surely.
We'll plan it.
Thank you very much.